Hi everyone, welcome back to our MCQ Marathon, and we are currently in part 4 of round 2, where we help you crack the audit code with questions for board exam preparation. Part 4 actually signals the last segment for round 2, just for round 2. So I'm kind of envisioning we'll be having a round 3, 4, 5, and onwards, as we never cease to help you prepare for either the licensure examinations or even your undergrad auditing theory subjects. Also, completing this part 4 segment, and if you have been religiously following our round 2, this will signify that you have effectively completed 100 questions for auditing theory. And so, in order for us to meet that mission, let's start with our 25 questions, one goal, CPA success. Now, our first question would tell us that several months after an unqualified audit report was issued, the auditor discovers the financial statements were materially misstated. Note that this discovery occurred after the issuance of the unqualified audit report. This means that if we look at the timeline of our subsequent event responsibility, then this already occurred in that period where the auditor simply waits for information to come to his attention. After the dating of the audit report, we are no longer responsible to obtaining sufficient and appropriate evidence regarding subsequent events, right? So the fact that the audit report was already issued, this is already forming part of that timeline where the auditor waits for information to come to his attention. So in this case, information has come to the auditor's attention that the FS were materially misstated. Now, the client CEO agrees that there are misstatements, but the CEO refuses to correct them. She claims that confidentiality prevents the CPA from informing anyone of the misstatements. Let's now evaluate our choices. Letter A would say the CEO is incorrect and the auditor has an obligation to issue a revised audit report, even if the CEO will not correct the financial statements. Or letter B, the CEO is incorrect, but because the audit report has been issued, it is too late. Or letter C, the CEO is correct, but to be ethically correct, the auditor should violate the confidentiality rule and disclose the error. Or letter D, the CEO is correct and the auditor must maintain confidentiality. So if you would remember our previous discussion with regards matters that come to the auditor's attention after the date of the report, should these matters come to the auditor's attention and should the client refuse to correct them, the auditor actually has the responsibility to prevent further reliance from these financial statements. And so the correct answer to this letter is letter A. The CEO is incorrect and we have an obligation to issue a revised audit report, most especially because the CEO is not willing to correct the financial statements. All right, so let's move on to our next question. After an auditor has issued an audit opinion, there is no obligation to perform any further audit tests or inquiries with respect to the audited financial statements covered by that opinion, precisely what we discussed in the previous question, unless letter A, material adverse events occur after the date of the report, or letter B, final determination or resolution is made on matters that had resulted in a qualification in the auditor's report, meaning to say there has already been a final judgment on the matters that made your opinion qualified in the first place. Or letter C, final determination or resolution is made of a contingency that has been disclosed in the audited financial statements. So the main difference between Bravo and Charlie is that the matter giving rise to the qualification is what was finally resolved in letter B, whereas in letter C, this only pertains to the final resolution of a matter that is disclosed, not necessarily a reason for the modification of opinion. Or letter D, new information comes to the auditor's attention concerning an event that occurred prior to the date of the auditor's report and may have affected the auditor's report. And I think we're able to recognize that the correct answer here is delta. This is the that second point in the timeline of our subsequent events responsibility, wherein from the balance sheet date to the date of the auditor's report, the auditor is responsible to obtaining sufficient and appropriate evidence regarding subsequent events. But after the date of the auditor's report, the auditor will only have to wait if new information comes to his or her attention. So the answer to this is delta. Next, we go back to the concept of operational audit. Which of the following best describes operational audit? Letter A, it concentrates on implementing financial and accounting control in a newly organized company. Letter B, it concentrates on seeking out aspects of operations in which waste would be reduced by the introduction of controls. Letter C, it attempts and is designed to verify the fair presentation of a company's results of operations. Or letter D, it requires a constant review by internal auditors of the administrative controls as they relate to the operations of the company. So whenever we talk about operational audit, this is somehow at times likened to what we call as management audit and is often tagged to be performed by internal controls. So the best description of an operational audit here is to seek out aspects of operations in which waste would be reduced by the introduction of controls. This is the reason why internal auditors are seen to assist management in helping them promote more effective and efficient operations. And one of the ways to do this is to seek out aspects of operations in which waste would be reduced. So the answer to this is bravo. Next, which of the following errors would be least likely to be discovered during the tests of bank reconciliation? Least likely. Let's evaluate the choices. Letter A, deposits were recorded in the cash receipts records near the year end, deposited in the bank, and were included in the bank reconciliation as a deposit in transit. And I think we would be able to picture out letter A as something that we expect to see in a bank reconciliation test, right? How about letter B? Payments on notes payable were debited directly to the bank balance by the bank and were not yet entered in the client's records. And I think you would also be able to see this one as a reconciling item in the bank reconciliation test. Letter C, cash received by the client subsequent to the balance sheet date was recorded as cash receipts in the current year, when in fact it was received after the current year. And again, this is something that you would be able to see by testing the bank reconciliation, as for example, comparing the balance per books versus the balance per bank. And so therefore, the least likely to be discovered must be letter D. Payment was made to an employee for more hours than the employee actually worked. Since the misstatement or since the anomaly happened in the hours worked by the employee, then when you take a look at the bank reconciliation tests, the amount reflected in the check will also be the amount cashed. So you will not be able to see the actual time records or time card of this employee in performing bank reconciliation. So that's why the answer to this is delta. Next, an auditor's report includes the following statement. The financial statements do not present fairly the financial position, results of operations, or cash flows in conformity with generally accepted accounting principles. In other words, the auditor is giving an adverse opinion. Now, this auditor's report was most likely issued in connection with the financial statements that are misleading. So when we talk about adverse opinion, this is born out of material misstatements or violations of our accounting standards that result in both material and pervasive misstatements. Next, there are several sources that the operational auditor can utilize in developing specific evaluations criteria. Remember again that the operational auditor is the one that is assisting management. We normally liken this one to the internal audit. It looks at efficiency and effectiveness of operations. So this operational auditor can develop specific evaluation criteria. These evaluation criteria is most likely the benchmarks or quotas or KPIs set by the entity. Okay, so if you talk, for example, about KPIs or their target number of days without accident and stuff like that. So this could be part of the specific evaluations criteria. Now, an area that would not be such a source is letter A, comparable performance, such as the data of comparable entities. Letter B, historical performance, such as results from prior periods. Letter C, generally accepted accounting principles. Or letter D, discussion and agreement between the management of the entity to be audited, the operational auditor, and the entity or persons to whom the findings will be reported. Note again that the very purpose of operational auditing is to help the entity make more efficient and effective operations. So in this case, the least likely source of these evaluations criteria is the generally accepted accounting principles, as this is the criteria used when we talk about external FS audit rather than internal audit. Moving on to the next question, we have here the case of an inventory acquisition that is received late in the afternoon of December 31 after the physical inventory is completed. Now, if the acquisition is included in accounts payable and purchases but excluded from inventory, this will result in. So imagine that they have already recorded the pertinent purchases, the relevant purchases and payable, but they have not included it in the ending inventory in the physical count because it was received late in the day once the physical count has already been completed. So for this, we can already imagine that the ending inventory is understated. So imagine your income statement, particularly your computation of cost of goods sold, and if the ending inventory is understated, this will only mean that your cost of sales will be overstated. And if your cost of sales is overstated, this will mean that your gross profit will be understated, and this will eventually lead to net earnings, which are understated as well. So the correct answer is Charlie. Next, which of the following procedures would a CPA most likely perform in the planning phase of a financial statement audit? Okay, so we're talking about the planning phase. Letter A, recalculate the prior year's accruals and deferrals. Letter B, make inquiries of the client's lawyer containing pending litigation. Letter C, perform cutoff tests of cash receipts and disbursements. Or letter D, compare financial information with non-financial operating data. Notice that the recalculation of the prior year's accruals and deferrals, including inquiries of the client's lawyers and testing of cash receipts and disbursements, all happen within the actual testing phase, or in the case of letter B, even near the completion phase. So the only thing here that is done normally in the planning phase is the comparison of financial information with non-financial operating data, which is also normally associated with the performance of our preliminary analytical procedures, which is done during the planning phase. So the answer is delta. Next, we talk about familiarity threat as invoked in the Code of Ethics. So, familiarity threat could be created under the following circumstance, except. So, we're looking for the exception. Letter A professional accountant accepting gifts from a client whose value is inconsequential or trivial. Think about receiving company ball pens during Christmas time, or maybe even company stationery, company merchandise, or even maybe a whole round of cake. These are gifts, but these are considered to have inconsequential or trivial effects to both the auditor and the client, actually. So this will not create a threat, okay? Not in any way, as they are inconsequential and trivial. Other choices, such as, for example, a member of the engagement team being the spouse of one of the directors of the client, is an example of a threat that is born out of an immediate family relation. And this will definitely give rise to a familiarity threat. Letter C, a member of the engagement team is the spouse of the chief accountant, so similar to letter B. Or letter D, senior personnel of an engagement team having a long association with an assurance client will also give rise to a familiarity threat. And this is one of the reasons why there is a designated period for rotation to help ensure that familiarity threat could be addressed or lessened. Next question. Which of the following procedures most likely would provide an auditor with evidence about whether an entity's internal control activities are suitably designed to prevent or detect material misstatements? So for this, we are talking about suitably designed, meaning to say we are still in the phase where we are looking at the design and implementation of the controls, not yet the operating effectiveness. And looking at the design and implementation of the controls would mean that we are still in the risk assessment phase, not yet the test of controls. So, as a brief recall, whenever we talk about the risk assessment phase, the procedures under this phase are our big three: IIO, inquire, inspect, observe. And in the case of planning, you can even throw in analytical procedures in the planning phase, right? When we talk about but since we're talking about the design of the controls, and it will simply be IIO. Now, when we talk about test of controls, then for test of controls, you will still have the big three, IIO, but you can throw in re-performance. So once we evaluate all of our choices, we get to see that those related to controls are only either Bravo or Delta. Because remember, when we talk about the risk assessment procedures for controls, we only have IIO, inquire, inspect, observe. So observe is there in letter B. But when we talk about test of controls, then we add in the letter R, which is re-performance. However, in this case, the question is very specific. We're looking at the design of the controls. And so therefore, because this is only the design of the controls, we are going to choose IIO only, inquire, inspect, observe. And so therefore, the answer should be Bravo. Observing the entity's personnel applying the activities because we're only looking at the design. Okay, next. As the acceptable level of detection risk decreases, remember, we're not simply talking about risk, assessment of risk, rather, we're talking about the acceptable level of detection risk. And remember, once the acceptable level of detection risk decreases, the auditor has actually become more strict. Okay, so we are looking for a stricter auditor. Amongst the four choices we have here, which one reflects a strict auditor? Letter A, the auditor may lower the assessed level of control risk from the maximum level to below the maximum. That means in the case of letter A, the auditor wishes to rely on the controls and would eventually perform less extensive substantive testing. Letter A actually reflects a more chill or relaxed auditor. So not the one we're going to choose, right? We're looking for the strict auditor. Letter B, eliminate the assessed level of inherent risk. And right then and there, we stop because we can never eliminate the risk of material misstatement. They are uncontrollable, okay, by the auditor. Inherent risk and control risk, uncontrollable by the auditor. We can't eliminate them. So not letter B either. Letter C, reduce substantive testing by relying on the assessments of inherent risk and control risk. And once the auditor reduces substantive testing, the auditor has become more chill, more relaxed, and this is not the auditor we are looking for. And so, therefore, the correct answer to this should be delta. Postpone the planned timing of substantive tests from the interim dates to the year end dates. In this case, the auditor endeavors to include the entire period under audit. That's why the auditor is moving the testing to to year end rather than interim. So this is a sign of a stricter auditor. So the answer to this question is delta. Next, the decision of whether the criteria are suitable involves considering whether the subject matter of the assurance engagement is capable of consistent evaluation or measurement using such criteria. Which of the following characteristics is not considered necessary in determining whether the criteria are suitable? And when we talk about the suitability of the criteria, we do recall the mnemonic run CR because run CR includes the characteristics of suitable criteria. Letter R for reliability, letter U for understandability, letter N for neutrality, letter C for completeness, and the other R, of course, for relevance. So in this case, the only item we didn't mention and is not included of our run CR mnemonic is letter B. Sufficiency is not part of the characteristics of suitable criteria. Next, we go to PSA 701. According to PSA 701, these are those matters that in the auditor's professional judgment were of such or were of most significance in the audit of the financial statements of the current period. It is selected from matters communicated with those charged with governance, which include significant findings from the audit of the financial statements of the current period. And actually, this is the very definition of our key audit matters, which is a section in our audit report that is required to be presented in the case of listed entities. So letter B is the answer to this question. Next, according to the profession's ethical standards, an auditor would be considered independent in which of the following instances? Letter A, the client owes the auditor fees for 2 consecutive annual audits. Letter B, an employee of the auditor serves as a treasurer of a charitable organization that is a client. Letter C, the auditor's checking account, which is fully secured by an insurance company, is being held at the client financial institution. Or letter D, the auditor is also an attorney who advises the client as its general counsel. So among the four situations we have here, the auditor is considered independent in the case of letter C because of two things. Number one, the client is a financial institution, meaning to say most likely a bank or the like, and so therefore the holding of the auditor's checking account is part of its ordinary day-to-day operations, no special treatment here. And number two, it is fully insured by an insurance company. So the answer to this is Charlie. Next, which of the following expressions most likely would be included in a management representation letter? And again, remember that a management representation letter comes in two forms. The first one is general representation, where management talks about the premise of the audit. Management acknowledges explicitly the responsibilities for the financial statements, including the determination of going concern and the design, implementation, evaluation of internal controls, as well as the responsibility to provide the auditor unrestricted access to documents and people needed to complete a satisfactory audit. The other representation, of course, is called specific representation. And in the case of specific representation, this is now the one that refers to specific assertions, transactions, events, or balances. So, which of the following would you most likely expect to find in a representation letter? Letter A, we do not intend to provide any information that may be construed to constitute a waiver of the attorney client privilege. Letter B, certain computer files and other required evidential matter may exist only for a short period of time and only in computer readable form. Letter C, there are no reportable conditions identified during the prior year's audit of which the audit committee of the board of directors is unaware. Or letter D, no events have occurred subsequent to the balance sheet date that require adjustment to or disclosure in the financial statements. So remember again that the management representation letter serves to reduce any possibility of misunderstanding between the auditor and the client, particularly with regards to the responsibilities of management. So in this case, the most likely statement to be found in the representation letter is letter D. Because, again, we do recall management is the one responsible for identifying and recording subsequent events. And therefore, management should include in the representation letter that they have not been able to identify any such event. Okay, unlike in the case, for example, of letter A, well, the auditor does not actually expect management to waive their attorney client privilege, so this has no place in the representation letter. In the case of letter B, this would normally be discussed in the ordinary course of the audit and maybe particularly during the planning phase, but then this does not necessarily make its way to the representation letter, as this neither forms part of the explicit responsibilities of management or the assertions, transactions, events, and balances. In the case of letter C, we are already looking at the current year under audit, but letter C still refers to the prior year's audit. Okay, so that's why the answer to this is delta. Next, we talk about proper separation of duties, and it is useful to prevent various types of misstatements. Again, we segregate the duties of care: custody, authorization, record keeping, execution. So, which of the following is not an essential separation of duties? Not essential. Letter A, persons having access to cash should not have access to marketable securities. Letter B, separate the credit granting function from the sales function. Letter C, personnel doing internal comparison should be independent of those entering the original data. So this is record keeping versus the monitoring or evaluation phase. Letter D, anyone responsible for inputting sales and cash receipts into the computer should be denied access to cash. So an example of separating record keeping from custody. So in this case, we have already seen Charlie and Delta as obviously essential separation of duties function. And to add to that, we also have letter B, separating the credit granting from from the sales function to ensure that only credit-worthy personnel will be granted credit sales. Otherwise, if you don't separate the two, then the salespeople might just keep on granting credit for the purposes of reaching a particular quota or target and therefore getting a bonus, right? So it is necessary to separate credit granting from the sales function. So not an essential separation of duties here is the access to cash and access to marketable securities, as both actually refer to custodianship, okay, of different asset accounts. So no, not essentially not an essential rather separation of duties. So this should be alpha. Next, we go back to RA 9298 and we are going to identify which of the following four statements is true. Letter A, after 2 years, subject to certain conditions, the Board of Accountancy may order the reinstatement of a CPA whose certificate of registration has been revoked. And if you have read the provisions of RA 9298, you'd be able to identify that this is a true statement. But do remember that the 2 years, okay, is not, or the reinstatement of the CPA who has a revoked license after 2 years is not automatic. Okay, this will have to be evaluated and later on decided by the Board of Accountancy. There is no such thing as an automatic reinstatement. Okay, letter B, insanity is not a ground for proceeding against a CPA. It is such a ground. Do you remember ICU? No, so insanity, being guilty of crimes involving moral turpitude, and of course, the presence of unsound mind. Or rather, the first I is immoral conduct, immoral or dishonorable conduct, and then crimes, and then unsound mind. So it is a ground for proceeding against a CPA. Letter C, the PRC has the authority to remove any member of the BOA for negligence, incompetence, or any just cause is not true. We remember that members of the Board of Accountancy are presidential appointees, and whoever appoints has the authority to remove. So it will be the President of the Philippines who may remove BOA members, subject, of course, to the endorsement of a recommendation of the PRC. But it's the president who does the actual removal. Letter D, a person shall be considered to be in the practice of accounting, professional practice of accounting in the field of public accountancy if he makes decisions for a private firm requiring professional accounting knowledge. This represents or refers to the private practice or commerce and industry. So the correct answer to this is alpha. Next, still in RA 9298, we are going to evaluate which of the following statements is incorrect. Incorrect. Letter A, candidates who failed in two complete examinations must enroll in refresher course of 24 units of the subjects given in the licensure examination. And we know this to be the correct statement, right? So after two complete failed examinations, required to enroll in a refresher course of 24 units in an accredited HEI or higher education institution. Notice as well that with the BOA resolution on refresher courses, the certificate of completion has an expiry period of 2 years. So after completion of the refresher certificate, the said examinee must take the licensure exams within a period of 2 years from the date of the certificate of completion. So letter A is a correct statement. Letter B, conditional candidates shall take an examination in the conditional subjects within 2 years from the preceding examination, and we also know this one to be a true statement. Letter C, to successfully pass the licensure examination, the candidates should obtain a general weighted average of at least 75% with no rating lower than 65% in any subject, and I'm sure we all know this one to be true. Letter D, candidates who fail to obtain a general average of 75 but obtains a rating of at least 75% in at least three subjects shall receive a conditional credit for the subject passed. This one, unfortunately, is incorrect, as this particular candidate needs to obtain a rating of at least 75% in at least four subjects. We currently have six subjects in the licensure examinations. We need a majority, so 1/2 plus 1, so that will be 3 plus 1. So we would need 4, 75% and above in at least four subjects to get a conditioned rating. Okay, next question. This one now refers to, if I am not mistaken, our quality management standards. How often should the firm communicate the results of its monitoring process on its system of quality control to engagement partners and other appropriate individuals? The results of monitoring must be communicated at least once a year. So this is an annual monitoring report. So the answer to this is Charlie. Next, we go back to CAMS or key audit matters. The description of a key audit matter is always required to include the following except letter A, why the matter was considered to be one of most significance in the audit and therefore determined to be a key audit matter. Letter B, the name and position of the management team to whom the matter was discussed with. Letter C, how the matter was addressed. And letter D, reference to the related disclosures. The item or the choice that is not to be included in the CAM section of our audit report is the name and position of the management team to whom the matter was discussed with. Okay, so letter B is not necessary. It's not to be included. Okay, now we go back to RA 9298 and our standard setting councils, FSRSC and AASC. What is the term of office of the chairperson and the members of these accounting and auditing standard setting councils? The answer is 3 years. So it should be alpha. Next, in the audit report, how are management's responsibility and the auditor's responsibility, respectively, represented in the standard auditor's report? And if you would notice the sections of the audit report, we do have a separate section for management's responsibility and another section for the auditor's responsibility. So, therefore, they are both explicitly included in the audit report. So, the answer is Charlie, explicitly, explicitly. Next, an auditor may issue a qualified opinion under which of the following circumstances. And to this, we recall that in the case of modifying the auditor's opinion, the auditor invokes a modification under two scenarios. Number one, if there is a misstatement or there is a violation or departure from the accounting standards. And number two, in the case of a scope limitation. Now, the modification that we call a qualified opinion may be used for both the misstatement or departure and the scope limitation. But when you talk and this will be true if the effects are material but not pervasive. So the qualified opinion is what I would like to call in the Filipino language as a balimbing opinion. They will not the qualified opinion does not care about the reason. The qualified opinion only cares about the effects. For as long as the effects are not pervasive, then no matter the reason, it's a go for the qualified opinion. However, when you talk about adverse opinion, this can only be given in the case of misstatements or departures from accounting standards that have both a material and pervasive effect. And in the case of disclaimer of opinion, this can only be given in the case of scope limitations where the effects are both material and pervasive. So a bit choosy in terms of the reason. These two very intensely negative opinions, right? Adverse and disclaimer. But in the case of qualified, regardless of the reason, for as long as it's not pervasive. So the answer to this, can you give a qualified opinion for lack of sufficient competential evidential matter and or restrictions on the scope of the audit? The answer is yes and yes. Okay, so Charlie, because we're talking about the qualified opinion, doesn't care about the reason for as long as the effect is not pervasive. Okay. Next, we talk about internal controls. And for effective internal control purposes, the vouchers payable department generally should, letter A, ascertain that each requisition is approved as to price, quantity, and quality by an authorized employee. And in the case of letter A, this is actually normally done in the purchasing department. Okay, we're looking for the one that is done by the vouchers payable department or that which is found in the accounts payable department. So it's not letter A. Letter A is done in the purchasing department. Letter B, establish the agreement of the vendor's invoice with the receiving report and the purchase order. This is what we call the three-way matching. And we normally perform the three-way matching once a request for payment is already starting to be processed, right? And the three-way matching is done in the accounts payable department or or the vouchers payable department. So the answer to this is bravo. Okay. Now, when we talk about stamping, perforating, or otherwise canceling supporting documentation after payment is mailed, actually, this may also be done in the accounts payable department, but then generally more performed under the treasury department. Okay. Letter D, obliterating the quantity ordered on the receiving department copy of the purchase order is done in the receiving department. So the answer to this is bravo. And we are down to our last question. This will officially seal off our 25 question mini mission for this part, for part 4, and our bigger 100 item question for the whole round 2 of our MCQ marathon. So to seal in our 100th question for the entire round 2, let's take a look at Pamela. So, Pamela CPA was engaged to audit the financial statements of one company now after its fiscal year has ended. So, Pamela was engaged to be the auditor after the fiscal year has ended. The timing of Pamela's appointment as auditor and the start of fieldwork made confirmation of accounts receivable by direct communication with the debtors ineffective. However, Pamela applied other procedures and was satisfied as to the reasonableness of the account balances. Pamela's auditor's report most likely contained a or an letter A unqualified opinion, letter B qualified opinion because of a departure from generally accepted auditing standards, letter C unqualified opinion with an explanatory paragraph, or letter D qualified opinion because of a scope limitation. Now, note that while Pam was not able to perform direct confirmation, Pam was able to perform alternative procedures and was able to get satisfactory results out of the said alternative procedures. Now, our auditing standards do not actually specifically require us to use a particular procedure, and so therefore, the use of these alternative procedures is deemed to be as robust as the confirmation request that Pam wanted to do in the first place. So therefore, the answer to this is that the auditor's report would still contain an unqualified opinion. So there you have it, my 80 friends. Mission accomplished. Our 25 questions for this part 4 and the bigger goal of a total of 100 questions for round 2 has just been accomplished. So salute to you all. Good job. You can now take maybe a little bit of time to give yourself a well-deserved break. And as soon as round 3 is ready, I expect to find you there once again for our total of 100 questions, one goal, CPA success. See you in round 3.